Hello, agents. Hello, everyone. Today, I'm going to talk about working in retirement, meaning working for your money instead of having your money work for you. I see this a lot. Anytime there's a new expense, a spouse is going to say, hey, we had this unexpected expense come up. We have to go and access your retirement to get this money, because they don't have any type of automated systematic system outside of maybe their Social Security or whatever they're getting. And they're accessing these funds. So here's 5 ways a SPIA can offer a fully automated retirement, basically. So let's take a look at this. 5 ways. 5 ways clients with SPIAs may have a more relaxed and automated retirement, because expenses must be paid no matter if you're retired or not, if it's a Monday or a Saturday. Expenses need to be paid. So let's look at set and level monthly expenses, such as like your mortgage or your car payment, right? So let's assume these are, let's say, $3,000 a month combined. Now you can purchase these for $3,000 a month. And we can also put a COLA on these, and I'll get into the COLA a little later. But here's the pricing on $3,000 a month for this 65-year-old. I'm using a 65-year-old male, but we're also using a 30-year period certain. So we're going to look at the life intent and the 30-year period certain for this example today. So here's some of the numbers. We'll get more into detail, but this is a SPIA that can guarantee $3,000 a month starting in 1 month for that 65-year-old. Now let's look at other monthly living expenses, such as utility bills, TV, internet, fuel costs, all that type of stuff. So let's call that $700 a month. So there's the $700 a month. This is the one with the COLA, and there you see your costs for all this, right? Now we'll get more into all this again soon. But let's take a look at the third. Number 3 would be periodic known expenses. So such as your property taxes or vehicle registration, stuff that happens once or twice a year. You can use semi-annual or annual payments to do this instead of the monthly. So let's assume that's $8,600 twice a year for your insurance and taxes and all that, or whatever you're going to periodically need those money for. Here's the cost for those, $8,600 semi-annually. So there you see it, semi-annually, and there's the 2% COLA. And you see the cost difference between the regular and the COLA. And what the COLA says is, hey, we're going to expect our TV and internet, or expect our taxes to go up by a certain amount every year. So 2 and 3 can add a set increase for anticipated price increases. Like in California, you know your property taxes are capped at a 2% increase. So that's very friendly. And you can design it. Hey, your property tax is $5,000. You can buy it for $5,000, increase it for 2% a year. And you can do that, and it's all guaranteed. So we like that. Yeah, here's the cost difference between the SPIA. This is the semi-annual payment. So you can see it's $216,000 for the life in 10 with no COLA, and it's $259,000 for the COLA. And these COLAs continue for life as long as the person's alive, or through the guarantee period. So there you see the price difference, and it's substantial. It's $50,000, $60,000 in some of these on a stretch. But the idea is, it'll offset inflation, right? It'll offset inflation. So what a SPIA is going to do for everyone is it's going to, no need for regular or multiple inquiries or requests for withdrawals from your retirement account, which usually needed at the worst timing, it seems, right? Oh, the market's down, but now I need the money, or whatever like that. So here's a way, you make the money work for you. You don't have to constantly going back. And this is a real life experience I know from certain people, and they had certain expenses, and it's not a conflict, but it does cause a little like head banging between the couple, because, I got to dip into the retirement again, and I wasn't expecting this. And, sometimes people will continue. One of them will, even though they have enough money to guarantee all these basic expenses and still have money left over as an emergency, one will keep working because they're not sure how long it'll last, because they don't have the SPIA. So honestly, people actually will work longer not using the SPIA just for the safety of it all, because you don't know what's going to happen, or if the money's going to go up and down, or if you're going to invade too much to earn enough on that money. So this is 5 ways SPIAs can make a more relaxed and automated retirement. Now let's go look through the overall costs to automate what we just discussed, right? So first will be the life intent on the 65-year-old male. So let's just look at the $3,700 and the 86, that was the semi-annual, and the total cost to fund that would be $785,237. So if someone's using over $1 million and trying to, pay fees and make enough interest to make this every year, nest expenses, their costs to live, it could be more of a headache, more of a stress, right? So now let's look at the 30-year option. Now there's no life. So if you die in that first one in the 11th year, all that money's gone, right? But if you do a 30-year certain option, what the 30-year certain says is, hey, no matter who's alive, it's going to pay for 30 years. So that does get a little more expensive, $896,000. But it's all guaranteed for 30 years. That's some serious planning. Total mortgage payments. And you don't have to do 30, we can do 20, we can do 15, we can do 10, 25, 27. We can do all different numbers there. But just to give you an idea, this exists. I bet most of you don't even know that this existed. Now let's look at the cost with the COLA. So we're going to use the life in 10. So it means if you live 30 years, it'll still pay that COLA for 30 years and you for that 30 years. But should you pass away, you're not paying for that guarantee of that COLA. So it's a bit less more money than if you would do the 30-year with the COLA, which I didn't price here because it was like way higher. So anyway, the 10-year life in 10 with the COLA is $938,000. Still under $1 million, cover all your expenses, guaranteed with that rolling 2% increase every year. So that's how it works. And that's the expenses for this person who needed $3,000 a month plus $700 a month for their basic expenses and $8,600 twice a year for taxes and insurance or whatever, taxes and, car registrations or whatever comes twice a year. So that's how that works. That's actual pricing based on the end of May 2025. And these will change, of course, as time goes on, could go up and down over time based on how rates move. But today you're looking at a 10-year treasury about 4.5. So, base it on that. Here's some important information. It's very important if you have qualified money and you're looking at, let's say, that 30-year, right? So the Secure Act has eliminated the stretch IRAs by requiring all distributions to designated beneficiaries be made by the end of the 10th calendar year following the year in which the IRA owner dies, except if it's a spouse, they can, or these other minor child, blah, blah, blah. You have some, but assume it's 10 years. So therefore, any period right here, right? Therefore, any period certain payout that would extend beyond the 10th calendar year following the last annuitant's death would be commuted at the end of the 10 years. So basically, if they live in the 30-year period, if they have a life in 30 and the client lives 20 years, it's going to pay the full 30 because you get 10 more years past death. But if they should pass away in the 10th year, it's only going to pay to the 20th year. And then the insurance company will commute the difference of those future payments in a lump sum. So you can still do it, even though some companies will default you right out. No, it's over 10 years. You can't. It's because they don't have a liquidity or a commutation, or they haven't figured this out. So it might be a non-assignable, non-commutable product. But so if you find products with access, you can do this. And it's a good idea. Because you can do long-term guarantees without worrying. And if you do joint life, it's even better. And I've done illustrations and videos regarding joint life and how that period certain, even on a reduced joint life, adds on. So the period certains are really amazing. And you can make your money work for you instead of you working for your money. Here's some more basic disclosures. Follow me on YouTube if you're not watching this on YouTube. I'm trying to get over that 500 subscriber mark, so I need 3 more people. If you guys can help me out there, that'd be cool. Yeah, that's the end of my presentation. Thanks for watching. And overall, let your money work for you. Stop working for your money. If you're getting hassled, constantly going to your account, or worried you're going to run out of money, or worried how a withdrawal is going to affect it, maybe look at a SPIA. If you're an advisor and you don't use SPIAs, it might be time. They're pretty simple. They're all guaranteed, and you can do some amazing things with them. So thanks for watching. Hey, remember, no fees, just insurance guarantees here at FSD Insurance Services. Follow me on X, YouTube, and LinkedIn for the most up-to-date information. And take care. Have a nice day. Bye-bye.